All right, testing. 1, 2, 3. Seems like everything is now good. Internet's working. The streams are going. Hello, everybody. I'm your boss, Joe Boss, and welcome to another week ahead trade plan stream. We got a couple of things to go over. And by the way, I am going to have the chat right in front of me. So I'm going to be able to read the chat as I go over some of the stuff in my notes. Now, I said in the last stream, my Friday stream, hey, there's a lot going on right now. I want to be able to do a little bit more research and figure out why exactly this drop occurred. That's not just happening here in the US side of things, right? If we go and check out a bunch of different assets, this is the S&P 500. We can check all these different equity indices. Look at Japan. Japan got hit super hard. This is the NASDAQ. It's just a big fat red bar, down 5.2%. So many of these assets got hit so hard. And the one thing I constantly hear is, oh, the primary explanation for the crash on Friday, the day we got this big fat red candle, has been that the positive NFP surprise that occurred and the positive surprise revisions to the last two NFPs increase the odds that the Federal Reserve will increase their cash rate. And at face value, that is very, very, very true. And a higher cash rate makes the interest on money more expensive, and that can reduce the amount of money companies like SpaceX, Google, Meta, OpenAI, and Anthropic can raise. Now remember, they're trying to get tens of billions, hundreds of billions combined by the end of this year invested into their projects for AI infrastructure. So, especially over the next quarter, July, August, September, those months, that's when they're trying to get this money in. So a couple of rate hikes during this period when they're trying to raise all this money can suck up several billions of dollars in interest, in increased debt, in opportunity costs. So let's kind of set the scene here. Most people are currently focusing on a 25 basis point rate hike at the December 9th FOMC rate decision this year after NFP dropped, right? Hello, Ani. Nice to see you. And again, guys, if you guys need to ask questions as I'm going about, just ask them. Because as soon as you ask them, I'll be able to interject and we'll be able to stay on topic by topic. Or I'll kick back and get around to it. But I'm going to be answering whatever you guys have to ask when we're going through this stuff here. So this was a killer day for all these assets. And it was because the headline reason, like I said at the very beginning, was, oh, there's this been big positive NFP surprise. And I said that increased the odds of FOMC rate hikes. And I said, yeah, on a face value, that's very true. But then when you actually read the headline and then you read like the first paragraph of two of these articles, they say, hey, it's because there's a higher chance now of a 25 basis point rate hike at the December 9th FOMC meeting because of NFP surprises and the positive revisions. And I was looking at that at face value. I'm like, I don't buy that. I don't really buy that at all. Because equity indices dropped around the world. It was, NASDAQ, we're looking at it right now, 5%. S&P, also 2.5%, 3%, depending on what chart you're looking at. Nikkei, the futures dropped 8%. Actually, this is the Kospi. This is Japan 255. That's Nikkei, and here's Nikkei. It's all around the world. And then indices in the rest of the world are also getting hit. You can see US 30. This is the Dow. That's down also about 1.6%. Euro 50. The DAX 30. France. What's it? BIST. Which one is this again? Can't remember. Oh, that's Turkey. And then this is J for South African index. So all these indices, all these markets all around the world for all these different countries got hit because of NFP, because of this December rate hike. Odd. And that I couldn't really, I was really not satisfied with that as like the correct way to look at this. Because if you just look, CAC 40, if you just look at what was priced in, let's say here on the 31st, this is the week before FOMC came out. So if we look at this column here for the Fed, here's the December meeting, 0.018. This little thing right here that's next to my head. I know you guys aren't going to be able to see it very easily, but what I'm going to do is put in 18 divided by 25, and that gives you your odds of a rate hike there. 72%. And then if we go back in time a little bit, so here's now the 10th. Look at that. The odds at the beginning of May were like, oh, no, Fed staying on hold the entire time. In fact, there's maybe even a little bit of a chance that they cut. If I like really, really blow this up, you can see it's like, oh, negative 0.2, negative 0.04, negative 0.06. Like they're saying, okay, we're going to be on hold if maybe get a cut if things get really, really bad. And then over here, this was the 17th. So this is a week later. It's like, oh, now we're probably going to start pricing in a hike in December. And if we do the same math, 8 divided by 25, if I added equal sign there, it's about 32%. So about around the middle of the month of May, we started to price in rate hike odds. And then here, the 24th of May, we were already at 18%, around that 72%. And then here's the 31st. We're also at 18% here. So the odds, the consensus expectations for a rate hike in December was already really heavily priced in, right? So that December FOMC rate hike was already the consensus expectation since the middle of May, at least about 3 weeks ago. So everyone who's doing analysis right now, focusing on this December rate hike, doesn't seem to know that, a December FOMC hike was already the baseline expectation. Seb had this at what we were just looking at, the odds at roughly 70% since the middle of May, that the Fed would hike in December. So it's like, what did this news, did this NFP news actually change change anything? Because if that already was the expectation, it's like, is that really that big of a deal? Is that really that big of a change in expectations? And in my head, I was going like, no, that does not seem to me like a reasonable market move, especially globally, to even a really, really good NFP. Something else must have changed. So instead, it seems like what has become the more serious issue, if I could real quick get this, and we can go ahead and close that real quick. It seems like what has become the more serious issue, especially for those companies I mentioned earlier, SpaceX, Google, Meta, OpenAI, Anthropic, all these companies trying to raise hundreds of billions of dollars, is that the odds for the Fed raising rates didn't just increase for December that everyone is talking about. It increased in September and October quite significantly, which, guess what, is right around the time when all these companies in combination want to raise their hundreds of billions of dollars to continue their infrastructure build out for AI. OpenAI could IPO in September. Anthropic's IPO is probably in October. Meanwhile, Google's raising $85 billion in equity right now on top of the $100 billion in debt that they already have. And Meta is issuing $25 billion more in debt right now. And we could go ahead and check out Meta's chart real quick. Meta. And you can see Meta got hit today. They were down 5.5%. We can look at Alphabet. That's Google. Google held up pretty all right. And we can check out the other shares. Yeah, Google's holding up pretty all right. So all this money in both these companies is just for more AI infrastructure. So when we look at NFP and think, oh, the market's crashed because, good jobs gives the Federal Reserve room to hike. It's like, well, yes, but no, that's not the end of the story here. You have to reason to higher order effects to find out what market expectations actually changed. So right now, if we look here, these are now the odds for FOMC in, let me just make sure you guys can actually see this, because I think my head might be in the way. Yeah, my head's just a little bit in the way. I'll move this guy over here and do that. Just that then it's a little easier for you guys to see that. You guys can see that, right? So right here, and if I do, there we go. I have this little drawing thing. So right here, that's September, and that's October. And these are the current odds. So the odds right now of hiking are for September. Before NFP, they were about 13%, right? Now, if you add up all these odds, you're getting somewhere around 35% here for September. And it's probably higher now. I'd argue it's probably the more realistic odds that the odds of hiking in September are now closer to 40%. And then if you look here, it says that the odds are around 50-50 of actually getting your hike over here with these odds. Because odds of staying still or cutting are around 50, so you just do the complement. So, real quick, let's do clear. So this is kind of a big deal, and these odds will probably continue to increase. So I would put the odds right now 40% for a hike in September, 60% odds for a hike at the end of October. So that makes things a lot more tricky for these companies that want to IPO and raise money in the immediate months ahead, right? So The odds of a rate hike in December went up. That is true. And they just became more solidified. They went from like 70 to 80 or 90. But that wasn't the thing that moved the markets. It was, oh, all of these guys are trying to raise money, and now the odds of the Fed hiking rates in the middle of their deals, in the middle of their closings, just shot through the roof and added additional risk, additional costs potentially. Again, when you're talking about hundreds of billions of dollars and then rates start going higher, you're talking hundreds of millions, a few billion of dollars more in fees, in interest. So the significant thing that NFP did was increase the odds that the Fed would hike much sooner at their September and October meetings here. 3 weeks ago, no rate hike was priced in for September, and the odds of an October hike were like 16%. Now the odds are around 40 for a hike in September and maybe 60 for a hike in October. This becomes a much more serious issue for these companies trying to raise money. Because this wasn't a risk that they had to be concerned about up literally until NFP broke. So what's the angle here? What do you think is going to happen next, Joe? I think the markets are going to go essentially sideways from here until we get some more clarity from these companies on their capacity to raise those billions of dollars. Like, do they have to change their deal at all? Do they have to reduce how much they actually take in? Are they going to accept higher interest rates, right? I personally don't think that this is going to be that big of a deal. If this was like the major risk that everyone was focused on and there was nothing else going on in the world, then I'd say this is like, I'd be incredibly comfortable buying this dip. However, other risks outside of the Fed are frankly of more concern than me, like reopening the Strait of Hormuz, and we have a huge wave of trade negotiations in practically every country. So how those trade negotiations are handled and what goes on with oil, energy prices, and Hormuz can be a way bigger deal than just, oh, do these companies have to pay an extra 25 to 50 basis points, 75 basis points more on the interest on these deals? I mean, I'm sure, or maybe just a little bit more, reduce how much cash they raise in order to accommodate by a few billion. Like, we're talking a lot of money here. And I'm certain that because of that huge amount of money, people in these deals are going to do everything in their power to try and make it work. I don't think these deals are going to go away because the Fed hiked once or twice, right? It just added a bit more uncertainty because these were not factors being priced into these deals or negotiated in these deals until NFP dropped. And it's like, oh shit, the odds of a hike were like less than 20%. Now they're closer to around 50%. This is kind of nuts. So, we're getting a little noise behind the screen here. I'll make sure to turn down the music just a little bit because I see it's getting just a tad loud. Let's see here. Let's check the audio bouncing. There we go. I think I like that. All right, so let me know what you guys are currently thinking. Broadcom fall the previous day had equity people talking of the top and keen to take profit. Yeah, well, maybe they knew what the Fed response was going to be, right? Broadcom. Yeah, check that out. Absolutely insane. What a fall. 20% from that top. Yikes. Yikes. It's not good. That's definitely not looking good. Now, there's a couple things here. There's one more thing that's a risk about these NFP reports that's notable. Most of the NFP job gains were likely related to hires in 11 cities in the United States for World Cup events, meaning that these jobs are likely temporary and we could end up seeing a rise in unemployment right around August or September when the events are done. And if these temporary workers aren't able to find employment elsewhere after this temporary work is complete. That could put the Fed rate hike odds for September and October's meetings back on the back burner if there isn't another wave of employment post this World Cup stuff. Now, if there is a rise in unemployment, steady or falling energy inflation, and even a slight NFP underperformance, then we could end up with no September or October hike. And falling energy prices is a big ask, right? But seriously, don't think that Trump won't try and do everything in his power to get energy inflation down ahead of the U.S. midterm elections, because we could very easily get surprises on that front to try and reduce prices to try and help the Republicans for political reasons. In the alternative scenario, though, if we have steady unemployment because those temporary workers aren't able to get back into jobs and they start claiming unemployment, you have steady inflation because energy prices, no new news, no new developments on the Strait of Hormuz, and no major fiscal or policy from the government at the United States level trying to suppress energy inflation. And NFP meets around consensus estimates. Maybe it's a little lower, maybe it's a little higher, but it's around even just consensus in the months ahead, that going into those September and October meetings, then I think that the odds for a September or October rate hike will just keep going up from here. And that's what I'm thinking. That's what I'm looking at. That's what I am watching next. So in about 20 minutes, we got all of our analysis done. At least all the macro stuff done. So now we're going to go ahead and go top down using the indicators here that you can get in the trading group, $100 a month. Just go to the link in the description and you'll be able to hop into our trade. Wow, check that out. So that thing you mentioned, Harold, with Broadcom, look at where we topped out, huh? Right there at a peak in the range probabilities. So this is the distribution of where tops for the month frequently occur. That's where the top occurred. And now, because we're experiencing this really huge economic surprise, we are experiencing price going into the tail distribution of our low returns for the month. So real quick, let's start off with oil. And let me know if there's an asset you want me to check out. So we're going to go ahead and check out the week ahead for oil. Oil is doing all sorts of movements. So let's see here. Yeah. Gonna have to probably check out a different chart because it's not much going on. The volatility is so freaking high on oil right now. Yeah. You can say when you change the charts. So this is now WTI versus CL. How the distributions change. That's because the data loaded into these charts historically is a little different. Alrighty. So let's see here. If oil stay, I mean, I don't know what the volatility for oil is going to be like because it's very, very exposed to these geopolitical events. So I would be on the more careful side, setting expectations for where exactly oil is going to go. The consensus seems to be that we're going to hang around 90. So we're going to be in this range, plus or minus around 90, until we get clarity about what's going on with the Strait of Hormuz. But we can't just wait for clarity for too long, because if you just keep waiting and waiting and waiting and waiting, there are supply problems going on right now in countries all across the world that we're watching in the trade research Discord. You can join that one for free in the WAP if you don't want to pay the $100 a month to get into the trading group. Then this is just such a huge problem for so many countries. If we just go sideways and sideways and sideways, or even go up and up and up, there's only so much the U.S. can do as far as exporting oil and gas. I mean, they're trying to ramp up production, and they're exporting like there's no end, and they're suspending the Jones Act left and right for all these different ships. They're really doing everything they can, and they're continuing to do so. But it's a matter of, I don't think the United States can be Atlas for the energy markets at the moment. I don't think they can hold up literally the entire world right now at the moment. Maybe they could, maybe next year or the year after, but it takes a lot of time and development. A lot of production went offline and was just outright destroyed when the attacks occurred at the Strait of Hormuz. It was a big deal. And that's why we're in this situation. It's because of those attacks. So if no peace is done and there's no more supply coming through, I really still would expect oil prices still to climb higher. I really do. It might be even around the time frame that we're talking about, September, October. And that could lead the Fed to do those hikes much more confidently. We could end up pricing in, guys, right now everyone's talking about, the rate hike in December. God, we could be pricing in 2.5 rate hikes this year. Like very, very shortly. Like going into late July, it could be a lot more clear that we start seeing much higher odds of more rate hikes if inflation isn't clearly being handled. Just straight up. If inflation keeps rising, it's going to push the Fed into hiking. So let's keep going down the ranks here. I like my currencies. Let's go ahead and start off with the weakest one. Wow, check that out for the month. Aussie dollar sitting there right there at a peak in the ranges. So do I think we will continue to go lower? Well, on shocks like this, you really have to be careful of continuations. And check that out, pretty low. It's maybe below S1.5 on the month. I would be definitely on the more careful side. Yeah, so maybe a bit lower. Maybe we even touch the 70 handle here. So maybe 70 pips lower. And let's check out the ranges for next week. Go to 6 hour for that. And check that out. We got our low right here at that peak in the ranges. Yeah, you can see there's also a peak right here at 70. So I'd want to set up an alert right here, just above 70, and maybe take a shot right under 70-ish. That's where I'd be kind of interested in. And we can set up a little reminder picture right there. Let's go ahead and check out the rest. Let's check out DXY, just for clarity's sake. So DXY, looking at this, I think it's a bit obvious, right? We're probably going to go to this peak right here. Probably find a top around the mid 100 handle. Set up a timestamp, 2020, 60606. Yeah. And then 1630. That's the timestamp. Let's see. There were some other things going on. I'm just going to delete this real quick. So we have this huge range of prior highs. I'm just going to mark these up on the chart just as a prior reference. Rectangle. Like that. So I wouldn't be surprised to see us trade around this area. Maybe there's some sellers around here of dollar. I really would not be too surprised. And you can see we even have peaks going all the way back to around here. Now the question is, if rate hike odds are starting to be priced in much more significantly, like I just said, you're not just getting the 1, you're probably getting the 2, 2.5 rate hikes priced in. We're definitely going to be going above this. Like that's easy. Let's see here. What would be a decent target? Well, on the quarterly ranges, that would be 102.2. So if we saw those increased rate hike odds for the meetings that are immediately ahead of us, and I think we're more likely to get that sort of commentary in late June, maybe mid-July. Probably more like late June that we'll more clearly see the odds go higher. So I would expect 102 to start being the trend for that reason. That I expect more rate hike odds to start getting priced in. Unless we see something clearly reverse on the energy side, right? 106 longer term, yeah. Oh, yeah. But we're going to need to probably reach 106, and sometime by the end of the year or first quarter, probably first quarter of 2027. That actually wouldn't be that bad of a target, considering we're currently expecting rate hikes out to March of 2027. So let's go ahead and timestamp this and put in our thingamajig. All right, so now we have our drawing. Let's make sure that we got it at the right spot. So I'd expect pretty clear positive drift. Pretty clear positive drift. Also, I need to make this green because that's bullish. We can't have the wrong colors, can we? And then make it green. And I want it painted green. Yeah. All right, let's check out Eurodollar. So Eurodollar is in a similar situation. And you can see my expectation is already for that larger scenario. And I'm like, huh. Now, I came to this expectation because I was just looking at something called timing dots. So this takes the current high for the month. And we can expand this just a little bit more. Yeah, it doesn't change much. But it takes the high for the month and it does a bound search. It looks around the current high and says, hey, when the top for the month was in this spot or around this little box right here that we're drawing. And I can zoom in for you guys a little bit. This little red box right here. Probably can hide it a little bit. Yeah, there's little red box right here. So it does a bound search around this high and finds similar tops. And that's what this green box does. It finds similar bottoms to the current low. Now, because we have a bearish expectation, we're like, okay, given the current top, we're following lows going to occur. And this is what the data shows. These dots, which is why it's called time dots, are saying, given this high, here have been where sequential bottoms occurred and what time they occurred at. And then these blue arrows are closes. So going from this low, where did it close? Where did it end? What was the rebound? And you can see, even though sometimes you close kind of close to the end of the month, you can still have nice little rebounds going into the end of the month. It's only when you close it closer to the middle of the month that you have like really significant rebounds. So yeah, there's a lot of closes, or rather a lot of bottoms for the month, somewhere around this 113 level. And you can see it's also varied in time, right? You have some that occur right here in 7 days, and then you have some lows that are occurring here over 22 days. So there's a lot of lows over time that occur in this area right here. And then you have another cluster around here, and then you have some tail moves like way, way, way down there. But what's nice is you can clearly draw some cutoffs, right? Like, okay, this blank spot right here is clearly the cutoff between all these dots and these tail risk ones. And then same thing right here. You can probably do a little cutoff like, okay, we're probably not going to touch these things if we come down here. And you can probably draw visually a line right here to cut off these dots from these dots, right? You can kind of intersect it right here. So with that in mind, that was the trade plan, right? Go to the nominal expectations. And then when we throw the ranges on top of it, look at that. This cluster of dots also happens to be right where we see a increase in the odds of finding probabilities of where the low for the month occur. So that's why you should give me $100 a month. Join the trading group. Get these indicators. Good, good, good stuff. Okay. So, what is going to be the next asset? I want to check out NQ. I really, really do. Because NQ has just fallen like a brick. And here's the SpaceX IPO. Man, this is just a total bloodbath. Look at that. Total bloodbath. So what's going to happen, guys? What's going to happen to the N, to the Q, to the NASDAQ, to the QQQs? What's going to happen? Are they going to die? Is this the end of the stock market? No, I don't think so. I don't think this is going to be the end of the stock market. Oh, man. I think, again, my expectation, like I said at the very beginning here, is mostly going to be some more sideways-y movement. Because you can see we had this very, very nice extrapolated trend right here, and we quite clearly broke that trend here. So this trend is now over. And I'm going to turn off the extend lines there. But it was a nice, clear, linear trend there. Nice and simple. And then it just dumped. So I think we're now going to be more or less, let's just say from here to here. No, that's still a bit of a throw, a bit of a stretch there. Man, I'm having a hard time finding these drawings. Let's see. I'm just looking for the rectangle. I mean, there's the rectangle right there, but then I realized there's also a parallel channels. That's what I want. So we'll just deal with this side as our baseline expectation for going sideways for now. Man, oh man, this has been one hell of a rally. One hell of a rally. So we'll just set that as the baseline expectation. If the Fed odds continue to increase from here, like I expect, then probably 25 is like what I'd start expecting. 26, 25. Like, we fell about, how many points is that exactly from the top down here. We fell about 1,900 points. Let's say we just do 1,000 from here. 1,000, 1,500. So that's 27. Yeah, low 27s would be kind of my first stop. Now, this is under the expectation that we actually see odds for more rate hikes actually coming through, right? Which means late June, we'll be getting some more information because we're going to be getting a lot of Fed speakers coming through, and they're going to be telling us their expectations. And then in June, we'll be able to qualify those things more, as well as the next FOMC meeting, because they're going to stay on hold that meeting. But we'll get some more information there. And that's where we could more clearly see the odds of them hiking in September and October, like, really solidify again if inflation stays the same or continues to drift higher. And no magic wand is able to be used to keep it down. And then you have, by the way, I'm just getting a little distracted by the music, so I'm just gonna, the music's a little bit louder than I was expecting. Yeah. When I mean I wanted background music, I mean literally I just wanted like the essence of background music. I like, man, if I have to talk over the music, that's when it's a problem, right? So again, if rate hike expectations start coming through, then I want to be a bear, because that's going to put even more costs on top of these deals that people weren't expecting. And then once the rate hike cycle here, this little mini rate hike cycle comes to a pause, then I would expect us to go back to rallying. That's what I would expect. So I expect this to be somewhat of a more prolonged downturn, but prolonged by a few weeks, by some sideways movement, and then back up higher. I personally don't think that, based on the deals that are currently on the table, that if it's just the FOMC hiking, that's not going to kill these deals. If inflation stays even just slowly inching up. A problem is if there's like a jump. If there's a 0.5% jump in inflation, if oil goes to 120 or above, that is a problem. Because all these data centers require the use of all this energy as well. So that would be the more serious concern. All right, so let's go ahead. 2026, 06, 06, 1644. So this would this is a more moderate, like 1,000 point, maybe less than 1,000 points further as rate hike odds continue to pile up. And then once the odds start to stabilize, if they do, then a rebound into Q3 and Q4. Then an equity rebound. That would be my expectation. Okay. Now let's go and do gold. GC. Gold fell, and I had a positive expectation on the month here, but it's just been getting hit harder and harder and harder, because as yields go higher, it's harder to put your money someplace that's not yielding. And right now, gold's been on a pretty bad bearish trend, so it's not been so great. It has not been such a great decision. I was expecting more sideways action, honestly, for gold. I was expecting more sideways action. And that did not happen because of these increased rate hike expectations, because of these increased yields. So this isn't so great right now. And there's just more miners, more people who hold gold right now who are willing to sell it in order to afford energy costs to keep their businesses up and running. Same thing like what's going on with Bitcoin. I did a whole rant yesterday on Bitcoin and Bitcoin miners, right? They just are running out of fuel. So they have to sell off some of the Bitcoin that they own to stay in business. Until they can actually afford some of the hardware that all these AI companies are taking out right from under them. Let's see here. So where is the next best spot here for gold? Oh man, it's hard. It's really hard to say. Because gold usually doesn't move like that. Those are some pretty crazy moves. So we're going to go ahead and restrict the look back here to the last 120 weeks for the last 2 years and see what we can do. So again, most of the lows are pretty bullish lows, right? 50% of lows are going to be above 4,300. So is gold able to rebound next week? It's going to be hard for me to say if I really want to have that expectation. A lot of the sentiment around gold is pretty bearish right now. A lot of those insanely high forecasts for like 7,000, 10,000, ounce gold are kind of out the window right now. I'd say if the Fed is going to continue to hike, gold's going to continue to struggle. That would be my expectation. So let's take a shorter term linear regression to the beginning of May and extend that out. Oh, I meant to hide the line extensions. And we can hide that real quick. So this is roughly the trend here. And we can probably scoot this back to Friday. Yeah. We can include this data in the data set now because this is all closed data now. So if there is a bounce, I'd expect the bounce to kind of be up to there and then back down. Something like that. Green 2026 or 606 1649. And we can hide the stats real quick. Hide the stats. So then we can very clearly see the arrows. All right. So a mean reversion back down. I think it's going to be a bit more. I think we're going to just be establishing this negative drift. Again, this is based on the assumption that we get more rate hikes. This is based on the assumption that the probability of September, October rate hikes continue to rise. And right now, I think that makes much more sense, given how much focus has been put on the December rate hike from this NFP. And then, no, I have literally not seen one other analyst go through the reports and say, oh, yeah, the odds for September and October hike have doubled or tripled. And that's the real risk, is not just, oh, there's going to be a hike in December. It's you could end up with 2 and potentially 3 hikes. I think that's the actual risk here. And that's why the market's actually sold off across the world. And I don't know if it's the reporters just intentionally not reporting on it because the people that they talked to didn't say anything, but I think that is the actual major risk. So I'd stay more on the bearish side of things. Higher time frame by a week. And let's pull this back by 250. Yeah, I think it'd be fair to expect some kind of a pullback. Real quick, I'm going to set this to 0. So we can see what it currently looks like. Yeah. So maybe somewhere up there. And then down. Essentially, it's the reverse of what we saw on the NQ. Right? Oop. Didn't mean to move that. It's the reverse of what we saw in the NQ, right? We had this nice trend that kept getting extended. Now it's just that trend, but in the opposite direction at this point. And again, because we have our underlying assumptions of exactly why we would be expecting this, I'm far more comfortable with making these expectations because I know where these expectations fail, especially where, oh, there's not going to be rate hikes. The odds of the rate hikes are starting to go down, and I know what economic data to look at to make sure. This economic data, if it prints, will increase the odds of rate hikes. This economic data, if it prints, will decrease the odds of the rate hikes. I know what data can update my expectations, so I'm more comfortable setting these kinds of expectations and then updating as new information comes in. And that is something that you will learn from reading outlooks, from being involved in trading communities that actually focus on research, right? So if you want to learn more, just hop into the free Trade Research Discord I've got set up and just start consuming a bunch of information. There's so many people lurking in that Discord who don't post a single thing, and then they send me a DM like, hey, Joe, could you give me some information on this? And I, instead of DMing it back to them, I post it into the Discord. So yeah, good stuff. Let's see, what else can we cover? Well, we could look at Bitcoin. And Bitcoin is not doing so hot. What's gonna happen? It's gonna stay range bound. Bitcoin's gonna be in the same little kiddie pool, swimming pool as gold for now. And I think I can just kind of leave it at that. And you can see how far in the tail we've moved here. Once Bitcoin started trading below 66,000, 67,000, that's like the point of, okay, hands off. This thing is now trading in the tail of its distribution of returns. And we can literally see that. So this spot here, this here is your distribution of where lows for the week occur. This green spot are where the odds are highest. And then you have a peak right here in this more gray zone right here where the odds are nice and high. And then you have this more opaque look and this more transparent gray. And this is where the odds get the most thin. And if you want to know what the exact probabilities are, you just look at the numbers here on the right. And you can see that quite clearly. So we can use these lines, these percentile lines, as 25, 40, 50, and you can change those in here. You can add whatever numbers you want. Hey, let's put the funny number in here. Actually, let's put both the funny numbers in here. Oh, that's where they both are, and conveniently they're right next to each other. So yeah, that's where the funny numbers are. And then if you want to remove any of them, just remove them from this list. Boom. There you go. Easy peasy lemon squeezy, as the Counter-Strike guys say. So yeah, this is the tail. Past here, when you start seeing these odds get really, really, really thin, it's a nice visualization of exactly where the tail risk begins. And not only that, but let's say you were short going into this. You know, like, oh, I need to kind of keep my hands off once we start trading down here, because this thing is probably gonna run. It's gonna ball, man. You're gonna make a lot of money if it just keeps going and going and going and going. But it's nice to know what that cutoff is, right? It's nice to know what the cutoff is around here when you start going lower. It's just this is the falling knife. Where does the falling knife begin? It begins somewhere around here, and it's nice to actually have an indicator indicate that to you. It's very, very, very nice. Alrighty. What else is there? What else can we look at? We can look at more currencies. We could probably look at a few commodities. So we're going to go ahead and bring up TLT. Here's ZB. ZBs are the futures. But let's check out TLT. Oh, and check that out. Our TLT expectations went as expected. I think we're going to need some more bearish expectations now, though. We're probably going to see more bearish expectations from here. So again, really wouldn't be too surprised to see things move a tad lower here. So let's do this. Back to the beginning of March. Yeah. All right. Let's get a little bit more accurate, extend those lines. Let's go to an 8-hour. Zoom right on in. So here's next week's odds. We can actually do a 12-hour and use the probability pivots. Yeah, something at least around there. Probably targeting S1 next week. That would be the easiest thing to do. And that's 59. Alrighty. So, what else is there to look at? We can look at some other cryptos. Oh, we can look at Master. At Strategy. Yikes. It's done so bad, man. It's done so bad. I really wouldn't be surprised if it bounced a little bit, though. I really wouldn't. Bounce or just started trading sideways. I think I would set up the expectation for more sideways week ahead for us. Let's use the full look back here. Let's see here. Next week. Yeah, it's because of the volatility, it's really hard to tell. So we're probably going to have to scrunch our look back here a little bit. Yeah. Yeah, the range is a lot bigger. It's like 110 to 130 for where we'd be stuck between, would be my expectation. Unless things get just that much worse. So I'd expect us to stay between 110, 130 next week. Unless, again, let's say they sell off even more Bitcoin. Let's say things got even worse for them. Well, yeah, that'd be pretty bad. It's started to increase further. Definitely Master would. I would expect Master to trade in the 90s, or at least the hundreds handle. In June, early July, if rate hike odds started to increase really significantly. Alrighty. I gotta check out something because it seems like my internet is doing something laggy. Is it laggy on your guys' end right now? Because it says my stream health is currently poor. Everything seems good. It says YouTube's not receiving enough data, but my OBS is sending all the data it can. Yeah, I'm not too sure what's going on there. It doesn't seem like. Yeah, and it says I have 0 dropped frames here on OBS, so that must be something going on over at YouTube's end. Yeah, and now it says my stream status is excellent. Yeah, so I wonder what's going on YouTube's end, because that's definitely not me. Yeah, that's definitely not me. Thank you, Harold, for letting me know. Let's see. Is there anything else to check out? Anything else? Man, Nvidia's down 6%. Holy smokes. Arc is down 7%. Yikes, Cathie Wood. Oh no, Cathie Wood. Man, Cathie still has not recovered from her claim to fame back in 2020. But yeah, I would definitely be on the more careful side. With a lot of these equities right now. Wait until you're my age, and the doc explains why your stream isn't what it used to be. Yeah, Arc did get hammered. There's a lot of things that got hammered. Okay. I'm pretty sure I've covered everything I wanted. Crypto, bonds, commodities, currencies, equities, global equities. I'm pretty sure I've covered everything that I wanted. Oh, and look, it says that the stream status is poor again. Oh no. Alright, I'll just take that as my sign to elegantly leave. Oh, the stream's been going on finally for just an hour and 6 minutes. Okay. All good, all well. I'll say, Harold, thank you very much for watching. Ani, Everyone who was also lurking, thank you very much. Again, if you want to join the trading group, $100 a month, you'll get access to the indicators and all the trading rooms that we have in there where we log all of our trades. And if you just want to join a place where you can do good research on your own with other people who are also trying to do good research on all sorts of assets, all sorts of geopolitical topics, join the Trade Research Discord in the WAP, link in the description, all that jazz. Leave a like. Let's go ahead, get the activity, get the subs and the likes and all that stuff going, because I would definitely like to do this a lot more. So I'll see you guys in the Discord. Let me know what you guys are watching in there, and I will see you all in a